This is Cindy Thomason, and I'm going to show you how to use the profit assessment tool that we've created for you. I hope you've downloaded it from our website so you can follow along. The first step is to enter your profit first data points. In our previous video, I showed you how to get the information into Excel from your QuickBooks Online file. So we have tabs for that information below. I want to show you how easy it is just to copy that information from your download from QuickBooks Online over into our tool. You simply want to select in the corner, and that'll select everything in your workbook, and we're going to copy that information over into the P&L tab. So everything is right there for you. Okay, so we have the profit and loss information pasted into our workbook, and we'll be using that information to complete the profit assessment tool. The first piece of information that's requested is our top line revenue. When we look at our P&L, we can find that simply by getting our total income line. Just going to highlight that so we can find it easily. Basically, we're going to take the total income and we're going to copy that over and paste it into our top line revenue. The next piece of information that we're looking for is your Cogs or your inventory value. And you're going to have to look at two places for that information. The first place, the easy number to find, is right off of your P&L. You should have it recorded as your total cost of goods sold. So we'll highlight that so that we can see it easily. But that's not the whole story. The rest of the information needs to come from your balance sheet. The balance sheet, we have to manipulate the data for just a little bit to get the information that we need. Because the balance sheet is cumulative over the life of your business, and we're only looking at data from January to November of the current year to match our activity in our P&L, we have to do a little bit of math with the information that you export. That's why we actually downloaded the information in two columns, the end of last year and all activity for this year. So we have to take the difference from those two time periods to be able to determine what actually relates to the current year time period. So in this situation, you want to just create a difference column. You want to set up a formula. In this case, it's cell C less cell B. You're going to take the difference, and that difference calculation is what's going to be used in your profit assessment tool. If you took just your ending balance for the end of November, it has all of the information for your business for the entire time that you've had the business financial records recorded. So you want to be sure you're isolating it to the time period so that it matches the information in your profit and loss. In this case, we're looking for our inventory asset information. At the end of our time period, in November of 2018, our balance was $25,600. At the beginning of the year, or the end of last year, it was $17,000. The difference between those two time periods gives us an increase in our inventory account of $8,600, and we have to add that in to our P&L information. So we want to pull that over. So we're going to take the balance from the P&L, and we're going to add to it the amount that we can attribute to our inventory for this year, and that tells us the amount of our cost of goods sold. We want to paste this number over in our tool. So in this situation, this particular company through November has sold $1.9 million in products. Their inventory purchases have amounted to $1,040,000. So the real revenue for the business is $903,000. That's the amount of money that you really have to work with to manage your business. In profit first terms, that's called our real revenue. Now we need to complete major accounts for profit first: the profit, the owner pay, the taxes, and the operating expenses. We'll go to our balance sheet to pull out the profit information. The next component that we need to add into our spreadsheet is our profit component. When we pull the profit amount from our balance sheet, it's simply looking at both what has increased in our bank accounts and also any change in the debts that we have in the business. It's not coming from the P&L, which is where you think you would find profit. Profit on our P&L is purely a paper profit. It does not really equate to the amount of money that you have available from the business's performance. So this $87,000 that we're showing as an increase in the bank account, we need to factor that in, as well as what has changed with the business as far as any debt that it's taken on or paid back. In this case, this business has a American Express bill that from last year to this year has increased to $27,000. However, they had some loans from the owner that they have paid off. So we want to factor that into the fact that cash went towards paying that debt as well. So we're going to simply run a total on this by pulling in these cells, the bank account, less the additional debt, plus what they have paid off against the loans that they've paid off. And we'll take that information and we're going to paste it onto our profit assessment tool. The next thing that we're looking for is owner pay. We'll start by looking for that on our P&L, and we can see that this particular business has a couple of areas where they have paid themselves, where the owner's salary is broken out, their health insurance is broken out, so we want to capture that. This may not be called out discreetly on your P&L, and if it's not, look back at your payroll register for your payroll account, look at your W-2 if that's handy, look at your last pay stub. That's where you want to find your owner pay information if it's not specifically broken out on your P&L. We also have to factor in if you've taken draws out of the business, and that information is recorded on the balance sheet. So when we go to our balance sheet, we can see that this business has two partners. One partner is active and has taken draws, the other has not. Again, we're looking at what happened this year. So the difference between where they are at the end of this year and where they started the year was $5,300. So we're going to add that to what we have on our P&L to get the owner pay. So let's just run a quick calculation here. We're going to calculate this health insurance. We're going to calculate this salary. And we're going to pull the information off the balance sheet, this difference column. And that's the amount that we're going to put for owner pay for this client. We'll copy it. We're going to go in here and we're going to paste it with the numbers, and that way we can easily see it. Okay, so that's our owner pay. Next, let's look for taxes. You need to look for taxes in two places. You may find taxes showing up on your P&L, or you may find them as a prepaid on your balance sheet. This particular business shows that they have taxes and licenses of $5,200. But in doing research on the business, I've determined that this does not relate to the business's income tax. It has more to do with excise taxes, franchise fees, etc. for their business. Those are not going to be included in our tax bucket for Profit First. Those will go into our operating expenses. So there's nothing listed on our P&L for taxes. Let's check out the balance sheet. The balance sheet has a lot of information regarding sales tax payable and payroll tax payable. Some portion of the payroll tax may be attributed to the owner, but we're not able to determine that. So we're going to leave the tax account information blank. That's not a problem. Many of our businesses do not have tax withholdings. They may not have made estimated tax payments. So we just leave it blank and include a 0 there. The final thing is we need to pull the operating expense information from our P&L and determine if there's any operating expense information from the balance sheet. We look at the total expense line. Let's highlight that so we can easily see it. And we also need to see that there's activity that has happened between other income and other expenses. This may impact your cash accounts, so I go ahead and include it because we're really tracking the cash with our profit assessment. Are there any accounts that we've not factored into our thinking? So let's just go through the balance sheet. This is where we just want to be sure we've got everything. We've taken into account our profit. We don't have to take into account accounts receivable. That's not really related to our cash. We've got the inventory assets taken care of. Then there's something listed here called undeposited funds. Not really sure why the business would have undeposited funds, so it's a question mark, and I've highlighted it. We go down, the next few items have to do with depreciation and office equipment. You would never include depreciation in your profit assessment because it's not cash related. The computer equipment, there was no change. If this person had bought computer equipment, it would go into the OPEX bucket. Accounts payable, again, are not cash related, so we don't include that in our assessment. We've already gotten the American Express, and we've gotten the bank loans and the loans from the owner recorded already. There's something odd going on here with health insurance. Perhaps they made an initial payment for a deposit. I'm not sure. Typically that would not be a negative number. We're just going to highlight it for now and to pay attention to later. There's also something going on here with payroll taxes. I'm going to include that in our little blue boxes here because we may need to factor that in. I'm not able to tell exactly how this business is handling payroll taxes, whether they've actually withheld that money to be paid later or whether that money has already left the business. Some minor sales tax payable recorded here. And then finally, there's a loan from the owner that we need to pay attention to. Okay, so we're going to pull the total expenses amount, and then we have to factor in what's gone on with other income and other expenses. So let's do our formula. We're going to take the total expenses. We're going to subtract from that the additional income that we've gotten in, and we're going to add to then the other total expenses. And that gets us everything off of our P&L. Let's try putting that information into our profit assessment and see how close we are. We're going to copy it. And if we paste it with the values, it'll show up much better. When we run all of the numbers, our total expenses show up as $926,418 compared to this real revenue number of $903,000. So our balance is off about 3%. That's close enough. I wouldn't do any more on this account. Some of the things that I'm not able to understand from our balance sheet, you probably would know whether they're impacting your cash or not. When I see a brand new set of books, I don't really understand all of the details about what a client may have done with undeposited funds. You know, is that cash sitting in a drawer or these payroll taxes payable? Typically, those payroll taxes are paid. So in the way that we work with Profit First is we want to get close. It's not accounting per se. And if we're within 5%, I've got enough information here to tell me how I can help this business improve. Now, from a bookkeeping standpoint, I would tell you, figure those things out. But I don't want you to sweat it. If you're doing this and you're not a bookkeeper, you don't really understand exactly how the numbers have come together. You see things that are maybe questionable on your balance sheet, but you get to within 5%, then your variance is okay, and I would move forward. So let's talk about what this profit assessment tells us. This profit assessment tells us that the money that goes out of the business for Cogs and inventory, really, you have some control over. It's not going to be the money that we focus on for allocating to our Profit First accounts. We want to pay attention to what's going on with our profit, with our owner pay, and with our taxes and operating expenses. So let's look at how this business compares to a benchmark company. Now, when Mike Michalowicz wrote Profit First, he researched thousands of businesses, and he realized that businesses operate differently depending on how much real revenue they have. So the first thing to understand from our analysis is, what is the real revenue? In this case, the real revenue falls between the $500,000 to the $1 million range. This business is close enough to the $1 million range that that's where I would use as our benchmark. So in this situation, the $903,000 of real revenue, we would look to have 15% of that allocated towards profit, 20% allocated towards owner pay, 15% towards taxes, and 50% going to operating expenses. So how does this business compare? Step 2, we'll look at that in detail. The allocation for profit is pretty close. It's like 14%. But look at owner pay. This owner is not paying himself or herself enough. I can't tell that they've set aside money for taxes, and their operating expenses are 87% compared to the 50%. In dollars terms, we can compare that over to the right here. In reality, this owner is spending significantly more on operating expenses and not rewarding himself for being an owner and not setting aside funds to pay for his taxes. So definitely need a plan of action here. Profit can be increased. Owner pay should be increased significantly. Taxes should be increased as this business has a profit, and operating expenses is where that decrease is going to take place. So this gives us the basic information for how we would move forward with this business, and we would significantly cut that operating expense line and try to figure out where they can be more efficient, more frugal, more innovative, so that those dollars can stay to reward the business owner and take care of the obligation to the government. That's it for our profit assessment. If you're stuck, we're happy to help. We've provided a link on the profit assessment. You can click on that link and it'll direct you to our website where you can get in touch with us, and we'll try to answer any questions that you may have. Of course, there's more information in the book. You can use the book to walk you through the details as well. We wanted to prepare this tutorial for those folks that might need an example to make it a little bit easier for you to see how we would actually put this into practice.